I'm delighted to present today our new special update to the DHL Global Connectedness Tracker. In response to this year's trade policy turbulence, we have expanded our tracker, we have updated our tracker with the aim to provide to you today the most comprehensive, the most timely view of the state of globalization and global trade that's available. For this edition of the tracker, we used over 20 million data points on country-to-country flows drawn from more than 25 sources. We focus on three key questions. First, how are policy shocks affecting the growth of global flows? Second, is geopolitical rivalry fracturing the world economy? And third, are international flows becoming more regional? I'll present highlights on each of these three questions, and then I'm going to do a quick demo of the interactive features of the tracker to show you how you can dig deeper and you can actually customize all of the charts in the tracker to look at the aspects of trade or globalization that are of most interest to you, by country, by region, and so on. So I'll end with a quick demo before I wrap up. Let's start with the growth of global trade in goods. Here's how global trade volumes were trending last year. And here I've added the data for 2025 year to date. Contrary to predictions that global trade might shrink or at least slow down quickly in light of tariff increases, we actually saw a big spurt in the growth of global trade in early 2025. And that actually brought global trade volumes up to 6% above the 2024 level as of March. And global trade has continued to run at 4 to 6% above last year's levels up to the most recent data available, which is from July. And actually, when I looked back at the historical data, because I wanted to try to put that into context, what I saw is that the expansion of global trade that we saw in the first half of 2025 was the fastest expansion of global trade that we've seen in any half-year period since 2010, excluding the COVID pandemic. One of the drivers of that strong trade growth in early 2025 was a surge of imports into the United States as U.S. buyers rushed to get goods into the country in advance of tariff increases. But that's the blue line here. That surge of imports into the U.S. peaked in March, and the global trade volume, that's the purple line, remained well above last year's level, even in June when U.S. imports volumes dipped below last year's level. So U.S. imports was an important part of the story, but it's not the only part of the story. Another big contributor to the strength of global trade was the expansion of China's exports, which grew even faster than global trade volumes. What's especially remarkable is how China achieved rapid exports growth despite declining exports to the United States. Over the first 8 months of the year, the data for China are a little bit more timely. Over the first 8 months of the year, China's exports value to the United States fell by $51 billion. That was a 15% decline in the value of China's exports to the US. But China grew its exports to the ASEAN region in Southeast Asia by a larger amount, $55 billion. That was a 15% increase in China's exports to ASEAN. China also grew its exports to Africa by $28 billion. That was a 25% increase in the value of China's exports to Africa. And China also grew exports to the European Union by $26 billion, which was an 8% increase on the China-EU trade lane. So quite a remarkable expansion of China's exports during a period when U.S. tariffs on Chinese goods temporarily rose to above 100%. One final point about the growth of global trade in the first half of 2025. The fastest growth wasn't in China, and it wasn't in the United States. If we look at trade value growth by region, the fastest growth was actually where we are today, this region, Sub-Saharan Africa. In Sub-Saharan Africa, the US dollar value of global trade, of total trade, expanded by 9.7%. The biggest contributors to that by country were Ghana, Zambia, Cote d'Ivoire, and the Democratic Republic of the Congo. The biggest factor was increases in the value of this region's non-energy commodity exports. There was increase both in value and in volume terms for that coming out of Sub-Saharan Africa. And then number 2 on this ranking was North America. So the second fastest trade value growth first half of this year was in North America, and that was driven by that surge of imports front-loading into the United States. Okay, so far we've looked at the most recent historical data on trade growth. Let's now turn to the future. Here we'll use the composite trade volume growth forecast that we assemble from 4 prominent sources for our DHL Trade Atlas series of publications. These red plus or cross symbols represent the trade volume growth forecast that we assembled back in January, before the recent wave of US tariff increases for that period from 2025 to 2029. So it's a baseline forecast established back in January. And the yellow bars here represent an updated forecast. We just pulled this together about 2 weeks ago at the end of September. And as you can see, trade growth forecasts, unsurprisingly, have been downgraded in response to tariff increases and increases in uncertainty about future trade policy. In particular, the current forecast calls for slower trade growth in 2026, most importantly. Looking at the trade forecast revisions by region, what we can see is that the biggest downgrade in global trade forecasts was for North America. The trade growth rate for North America over the 2025 to 29 period was cut almost in half. There were also downgrades for almost all of the other regions. There were just 2 exceptions where trade forecasts were upgraded slightly, and that was for Middle East and North Africa and South and Central America. Those 2 regions generally have countries that, most of the countries face relatively smaller US tariff increases in those 2 regions, and also the outlook for the Middle East is boosted by increases in oil production and exports in the Middle East. Looking at that new forecast, the one that we just pulled together at the end of September, what we can see is that it calls for the world's fastest trade volume growth through 2029 to be in South and Central Asia, followed close behind by the region where we are today, Sub-Saharan Africa. So we're expecting the second fastest trade growth over that 5-year period to be in Sub-Saharan Africa, and then following next is Middle East and North Africa. Going back to the global data, I'd like to make one final point about global trade growth, and it's, I think, rather surprising. Here, I've added onto the slide the actual growth that took place in global trade volumes over the past decade, and I added 2 horizontal lines onto the slide. The line on the left is the compound annual growth rate of global trade volumes over the past decade, and the line on the right is the forecast annualized growth rate of global trade volumes through 2029. Having a hard time seeing the difference? They actually turned out to be the same. They're both 2.5%. I think that's pretty interesting. It seems even with tariff increases, what the forecasts tell us is that trade is still expected to grow as fast through 2029 as it did over the past decade. Tariffs are expected to slow, but not to stop or to reverse global trade growth. Moving beyond trade growth, for a sense of whether globalization is advancing or retreating, we need to consider measures that look at international flows relative to domestic activity. In the report, we provide an update on our DHL Global Connectedness Index, which does this across 14 types of trade, capital, information, and people flows. Here I'll just highlight 2 of those measures. This graph here shows the value of exports in value-added terms relative to world GDP. So what it's measuring is how much of all of the value of goods and services produced around the world is traded and ultimately serves a foreign market. That was at a record high in 2022, and it remains close to that record high as of the most recent data. On the right side of the slide, I've added a measure for mergers and acquisitions. So here we're tracking what share of all the M&A transactions that happen around the world cross national borders, and similarly, there's been no major change in that measure in recent years. It's in line with basically the average over the past couple of decades. These data and other measures in the tracker that tell similar stories, I think, are quite important because they tell us that companies are not redirecting their attention from foreign to domestic markets. To the contrary, companies are continuing to invest in international markets at rates that are roughly in line with what we've seen historically. Coming back then to our three questions to summarize the results on the first one, regarding the growth of global trade has been quite resilient. We've seen trade continue to grow even in the face of tariff increases, and there's no general shift from international to domestic business. Moving on, our second question was whether geopolitical rivalry is fracturing the world economy. Let's start with an update on the increasingly fraught ties between the world's two largest economies, the United States and China. The data in the tracker show declining ties between the US and China across a wide variety of areas, trade and investment, even scientific research collaboration. You can track how those are declining between the US and China. Here I'll just highlight the trade trends. The shares of US exports and imports involving direct trade with China started to fall during President Trump's first term, and these declines have accelerated since President Trump returned to office. The imports trends are quite dramatic. Back in 2017, 22% of US imports were coming in from China. By last year, 2024, that was already all the way down to 13%, and over the first 7 months of this year, it's declined further to 9%. Looking at the same flows from the perspective of China, the Chinese data indicates somewhat smaller shifts, but the same trend is also apparent. Separation between the US and China is clear from both. In the report, we get into some of the caveats about that kind of analysis, but the major story is clear: diminishing ties between the world's two largest economies. For a broader view of geopolitical shifts, what I'd like to do is to show you the composition of all trade around the world, divided up into geopolitical categories. And to do that, I'll use a classification of countries into close allies of the US, close allies of China, or more intermediately positioned countries geopolitically, that was developed by Capital Economics. The US close allies group of countries includes major European economies, as well as other Western-aligned countries such as Japan, Canada, Australia. The China-aligned bloc includes, for example, Russia, Pakistan, Iran, and a variety of smaller countries, mainly in Asia and in Africa. South Africa, where we are today, appears in neither bloc. That's because Capital Economics classifies South Africa as leaning toward China, but Capital Economics doesn't classify South Africa as either a close ally of the US or of China. Using those classifications, let's look at the composition of all trade around the world. And I'll just make one remark, since I noticed a lot of you looking at those charts, seeing the flags, how do the different countries classify? In the online tracker, you actually have a choice of classifications. So if you want to test that out, see how it looks with Capital Economics, see how it looks with classifications used by the IMF, used by the WTO, you can just do that in the interactive online version. Using the Capital Economics classifications, let's see the composition of all trade around the world and how it divides up into those categories. Here's the share of world trade happening directly between the US and China. That's fallen from 3.5% of world trade in 2016 down to 2.2% as of the first half of this year. So that's a substantial decline in the US-China trade lane, but it's only a little bit more than 1% of global trade, so pretty small in global perspective. Here's trade between the rival blocs of close allies. That's down from 12.5% to 10.2%. What we saw there is that the share of world trade crossing between these rival geopolitical blocs started to fall after the full-scale invasion of Ukraine. It declined in 2022, declined in 2023. It actually stabilized in 2024, but we see another small dip in the first half of 2025. So there is also a small separation trend here between the blocs of close allies, but again, it's actually pretty small in global terms. It's about 2% of global trade. So, thus far, at the bottom of this slide, you see all of the trade that is most vulnerable to geopolitical tensions, the trade that happens between geopolitical rivals. Now let's look at the opposite. Here's the trade that is between the friendliest groups of countries. It's the trade that happens inside of those blocks of close allies. 2 points. One, there's a lot more trade happening between the close allies than with the rivals. And it's actually a stable share of world trade happening among close allies. If there was friendshoring, you'd actually expect that to be increasing. Instead, it's stable. So we're actually seeing more of a de-risking than a friendshoring. Less trade crosses the blocs, but it's not shifted to more happening with allies. Instead, more of the growth is with the intermediately aligned countries or countries with flexible geopolitical alignments. That share of world trade has increased from 42% to 47%. One of the key reasons that we don't actually see bigger geopolitically driven shifts in global trade patterns is that, or in global flows, is that as we saw on the previous slide for trade, most international business activity already happens among friendly countries. So for trade, when we run the numbers, there's 3 times more trade happening among close allies than with geopolitical rivals. And the difference is even greater when it comes to business investment. So last year, we saw 9 times more foreign direct investment projects among close allies than with geopolitical rivals, and 20 times more mergers and acquisition transactions. So on how geopolitical tensions are affecting patterns of international activity, there clearly are some shifts, but they're mostly apparent between countries that really have the most acute tensions. So for example, US-China. For the world as a whole, geopolitically driven shifts in patterns of business are actually still pretty small. On then to our final topic, are international flows becoming more regional? There's been a lot of interest recently in nearshoring and the possibility of moving production to closer to customers, which could lead to more regionalized trade patterns. In recent years, however, we've actually been tracking the opposite pattern in the global trade data. So here, the graph that's on the screen shows what % of all trade around the world happens within roughly continent-sized regions. That's been declining. It reached a new low of 50.7% over the first half of 2025. And because that measure that I showed you, how much of trade is within regions, it depends a lot on where you draw the region boundaries, how many regions you use. We also track the average distance in kilometers over which all trade takes place. If trade was becoming more regionalized, you'd think it would happen over shorter distances, because regional trade is short distance trade. To the contrary, the average distance that trade is traversing has been rising, and we hit a new record high, new record long distance for trade in the first half of 2025, which was 4,990 kilometers. So furthermore, it's actually not only trade becoming less regional, greenfield FDI has also been trending toward lower levels of regionalization and longer average distances. For M&A activity, there's no clear rising or falling trend for regionalization. So the data clearly show no general pattern of business becoming more regional so far. There certainly are reasons why trade and other aspects of business might become more regional in the future, but that clearly has not happened so far. Before I conclude, I'd like to very briefly show you how you can customize the data in the tracker to look at the aspects of globalization that are most interesting to you, the places that are most interesting to you. If we can show the laptop here. There are 15 charts in the tracker. All of them have interactive features. You can drill into all of the analyses that I showed you in the presentation and many more. Here, I'll just show you one of the charts. This is a chart that you can use to track the changing shares of flows that happen between any pair of countries or regions. This is the chart that I used to show the declining share of US imports that comes from China. One of the new features in this edition of the tracker is that to get even more timely, we've added the ability to go to monthly data instead of annual. And when you do that, we can zoom in on the most recent periods. So there, if we just start in 2024, go to the monthly data, you can see that the share of US imports coming from China actually started to go down at an accelerated rate right after President Trump was reelected. It shows how responsive importers are, and actually quite a bit of flexibility. Didn't wait until inauguration, didn't wait until tariffs started going. The line starts to go down after the election. And then you can see, where are alternative sources. So for example, you can see in recent months a sharp uptick in the share of US imports coming from Vietnam. Of course, since we're in sub-Saharan Africa, I'd like to show some examples from this region. So we can switch United States, for example, to, let's go first to the region. If we go to sub-Saharan Africa, yeah, right there. So we can see, contrary to the US trend, a rising share of sub-Saharan Africa's imports have been coming from China. This also, of course, works by countries. So if we can go to South Africa, you can see rising share of South Africa's imports generally has been coming from China. Of course, you can choose any pairs of countries or regions. I thought it was interesting to see that there's been an even more notable acceleration in the share of South Africa's imports coming from India recently. So that's just one example of the 15 interactive charts that you can look at in the tracker, which is available free to everyone online. And with that, if we can go back to the slides, I will wrap up. So looking across all of the data in the tracker, all the points in the different slides, my bottom line take on the state of globalization is, despite policy headwinds, globalization has not gone into reverse. Companies and countries are managing the risks of a more turbulent world. They have not shown signs yet that they are retreating from international engagement. Thank you very much.